I'm Jeanne Gray, founder and publisher of American Entrepreneurship Today, a website that brings news and valuable information to entrepreneurs, innovators, and investors all across America. Our podcast series, Experienced Voices, explores the journeys of very successful people in the entrepreneurial arena who are open to sharing the key elements that led to their great success. Today we have Howard Lubert, a seasoned investor with over 3 decades in the private equity space. For the last 11 years, he's been at the helm of Keiretsu Forum, MidAtlantic and SouthEast, a community of accredited private equity angel investors, venture capitalists, and corporate institutional investors. In his career, Howard estimates that he has reviewed well over 10,000 company pitches, and he can quickly assess those that have potential and those that do not. Welcome, Howard, to Experienced Voices.
Thank you, Jeannie, for having me. Well, let me start by telling you that this past March, I celebrated 36 years of involvement in the private equity space. It started when I was asked to look at a company for Safeguard Scientifics, a venture fund that's no longer out there, but back in the day was notable in that it was the very first publicly traded VC fund on the planet. And I started Keiretsu 11 years ago this past March as a result of bumping into some Keiretsu Forum members at a conference I was attending in San Diego. And in listening to them describe their process, I became instantly interested, having looked at angel groups in the Philadelphia area 12 years ago and 15 years ago, and not really finding anything that got me excited about doing angel investing. So I've been doing this a long, long time, and I credit the work that I did with Safeguard in the venture capital space very much for the result of having created what have turned out to be 2 very successful regions in the Keiretsu network.
So if a deal is going through Keiretsu Forum, MidAtlantic, or SouthEast, what's your role specifically in your involvement? Are you involved in some of the discussions, or do you have just simply oversight as things progress?
Well, I have on my team a director of due diligence who is hands-on involved from start to finish with every due diligence process. Unlike most angel groups, if we invite a company into due diligence with us here in the Mid-Atlantic or Southeast regions, it comes with the understanding that, like a VC fund, we are also going to negotiate the term sheet. And I negotiate every single term sheet for every single due diligence project that we do. So I'm very hands-on. And I'm, I guess, kind of pleased to say, from an egotistical kind of side, that in the 36 years of being involved in this, the term sheet that we use is something that's evolved over that time. And it's an extremely aggressive but fair term sheet, but does something that unfortunately entrepreneurs don't think about. And that is, we've designed a term sheet that absolutely excites and attracts investors to write checks. And at the end of the day, no matter which term sheet you use, if it doesn't attract investors who write checks, there won't be a company. So I'm very hands-on and involved in every single deal we do from that negotiation of the term sheet.
Can you share or refine what you said about why it attracts, angels to write checks?
Sure. So as you can imagine, there are literally tens of thousands of companies looking to angel investors every year for funding. The competition is incredible. There is, however, a differentiation between Keiretsu and many of the other angel groups that are out there. And that is that we are not doing raw startup investments. We're coming in later when the company's a little bit more mature. And as a result, perhaps the competition is even more exceptional at our level because there are very few venture capital funds that are investing in early stage deals like we are. And in fact, Randy Williams, the founder of Keiretsu, would tell you that he positioned Keiretsu as the stopgap to fill in that space when the early stage venture capitalists moved upstream. So when you assume that there are 100 deals available to every angel investor to write a check in, there need to be strong differentiators. Number one, there needs to be a strong due diligence report that helps vet the deal and help the investor understand what it is he or she's investing in. But then on top of that, by having a very strong investor-friendly term sheet that, shall we say, offers a better return on investment than the other 99 deals, that's kind of the icing on the cake to us that help motivate our members and other investors to write checks in the deals that we bet.
So how do you move the entrepreneur forward through what you're saying is terms that are very investor friendly, but they're thinking they can go to a different angel group or maybe not, in which they accept this little bit more favorable approach to the investor through your term sheet? So because they're learning, they're doing this sometimes for the very first time. How do you kind of nurture them through?
Yeah, well, we start at the very beginning with the entrepreneur to suggest a number of things. Number one, and most important, we sit across the table not as adversaries or competitors, but as partners who are about to get married and be together for a long period of time. And it needs to be a win-win, positive relationship, or it won't work. So with that positioning, we then go into the psychology of why this particular term sheet has been so successful for so long, and why, while on the surface it may look like the company is giving up more than they might have to if they went another route with another angel group with a different investment document. At the end of the day, the success factor of our term sheet in our due diligence speaks for itself. In fact, it's interesting that I can tell entrepreneurs that if you're able to get through due diligence with us and negotiate this term sheet, we have been successful in funding 99% of every company that has come to us and used this term sheet. We've only had one company in our 11-year history not get funded going through our due diligence and using this term sheet.
That's pretty impressive. So if a entrepreneur is listening to this podcast, what do you define as early stage?
We're the guys that typically want to make the first quote unquote formal round investment, typically Series A, and then follow on with Series B, C, D, and so on, depending on the space the company's in. So we're the guys that typically come in after the self-funding, the friends, family, and fools round, and perhaps even an earlier stage angel round, like a seed round. We're the first, quote unquote, typically formal round. So we're the guys you come to for that Series A. Our sweet spot, we tell people that we will invest between $500,000 and $3 million in that first round. The reality is we've never done a round less than $1 million. And I just closed the documentation for a Series B that we're going to lead starting this month for $20 million.
So in the specific company or entrepreneur who's looking for funding for his company, is it revenue producing, or, the whole aspect of proof of concept moving into, revenue producing repeat customer? How would you have them self-assess that they're eligible to approach you?
From a positioning standpoint, it's very silo specific. So if it's a life sciences pharma company, they're not going to be anywhere near revenue. They're not going to be anywhere near FDA approval. And our decision to invest and work with them is obviously going to be based on a very deep due diligence into the quote unquote secret sauce or IP that they're working on, whatever that space is. If they're a medical device company, that's a much shorter tail. But again, they'll likely still also not be revenue generating. If you get out of life sciences and look at the other silos that we're very active in, technology, consumer products, clean green energy, et cetera, it's very helpful if the company's already generating some revenue. But I tell the entrepreneurs in those spaces, the perfect inflection point to come to Keiretsu Forum is the company that is ready to transition from R&D into sales and marketing.
Okay. So let's take a step back. So you handle two regions of Keiretsu Forum, MidAtlantic and SouthEast. Can you explain a little bit about how those two regions are set up, where they're located? Are they chapters within the regions, just so that we understand where your footprint is?
Sure. So we have 5 chapters in the Mid-Atlantic region. We started in Philadelphia and then ironically expanded by invitation into DC, followed by Pittsburgh. We then acquired the rights to the New York chapter. And just before the pandemic started, or actually as the pandemic was finishing its first year, we quote unquote opened a chapter in what we refer to as North Jersey, but it's actually headquartered in Princeton.
Right.
In the Southeast region, we have chapters in Southern Florida, located in West Palm Beach, and Atlanta, with plans, once we get back to live meetings, to expand into the Raleigh-Durham Research Triangle Park area and possibly Charlotte. So within Keiretsu Forum in North America, there are 7 regions that make up 33 chapters. And we have the East Coast with one exceptional outlier, and there is a single chapter in Boston.
And within the chapters or each of the forums, a significant portion of the members are accredited investors, true?
With the exception of our due diligence fellows, 100% of our members must be accredited investors by SEC definition, or they can't join Keiretsu. The interesting thing is that we also have a very active sponsor base. So we have law firms and accounting firms and PR firms, for example, that pay us for the privilege to become sponsors so that they can market and network not just to the entrepreneurs who are coming through, but also to our members. And they are also accredited investors as well.
So when an entrepreneur approaches the forum and they're pitching, is there a sweet spot? You mentioned life sciences, or are you have a broad range of industries represented in who are funded?
Yeah, Keiretsu is Keiretsu is very unusual compared to the typical angel group. First of all, of the over 350 angel groups in the United States, over 80% of them are doing seed and startup deal stuff, unlike Keiretsu. And of the other 20% that are doing later stage deals, the interesting thing is that the vast majority of angel groups invest in 1 or 2 silos. Keiretsu is the exception, again, because of our size and our breadth. We've invested in 14 different silos. But that said, there are 5 key investment areas that for the past 10 years that we've been involved, in order of interest, have been life sciences, then technology, then consumer products, on the West Coast, real estate, here, clean green energy, and so on and so forth.
So I know you run meetings with for your member investors. So where is the pathway in for the entrepreneur? Is it being referred by someone, or they're just simply contacting you directly and pitching to you that they would like to have access to your group? And when, quote unquote, if you give an entrepreneur access to your group, what does that mean?
The process is very definitive and pretty straightforward. It starts with us receiving an application from the entrepreneur and their company that they're interested in talking to us about funding. And those applications can come to us a couple of different ways. Number one, you can go to, you can go to our website and click on the Entrepreneur tab and read through the materials that will lead you to a button that will take you to our online application form where you can complete the application. If you have previously completed an application with another angel group, there's a strong likelihood that it's on the same platform as us, and you can ask that group to syndicate that application to us. And then third and final, obviously with a network of 33 chapters, we get a lot of deals where entrepreneurs have applied first to another region of Keiretsu, and now they're actively funding, and they want to syndicate to us to give our members an opportunity to see the deal, in which case they typically come to us already with a Keiretsu due diligence report and a term sheet. And we're happy to see if we can't help fund those.
So if I'm walking through the door and I'm an entrepreneur, somehow someone referred me to you, what is my first touch? Am I invited in to give a deck presentation, or are you opening it up for one of your expos? So what's my first real experience directly into the group?
So again, like everything else in Keiretsu, the process is very rigid. So the first thing that has to happen is we have to get an application, and we get applications in every week. Every single one of those applications are typically reviewed the following Monday morning by my vice president of entrepreneur services and myself. And from that, our goal is to identify the top 10 or so of those applications and invite those companies to come present to us at a screening meeting, which we typically hold on the first Wednesday of every month. The goal of that screening meeting is to pick the best of those companies that presented, and the entrepreneur comes away typically with one of three alternatives. Number one, we loved what you did. We're going to invite you to present to our members. Number two, we don't like what you did. We're sorry. We're not going to be a good fit for you. Good luck with your company someplace else. Or number three, we like what you're doing and we think there's really something there, but unfortunately you did not resonate well in our screening meeting. We'd like to help you get that fixed and then come back to a second screening meeting with the hopes that that would then move you into forums in front of our members. So those companies that are successful in screening are then invited to forum meetings. We hold one every month, 11 months a year. And from those forum meetings, our members complete gold sheets, which indicate the level of interest in those deals. And from that, companies then get invited into due diligence and hopefully come out of that due diligence and get funded.
Is there, again, looking at it from the point of view of first approach, are there elements of an early stage company in which it's a deal breaker at the very beginning, meaning I'm a founding entrepreneur, but I do not have my team in place, or I have not done this or done that. So is there just, the deal breaker at the very beginning? Someone's approached you, they look like they fit, but they have not really expanded their model out sufficiently, and you guys see it right away. And, some of the ones you say you need to go on to another funding source.
Well, yeah, I think in trying to help define quote unquote deal breaker. So the process with us is a two-way street educational model from the very, very beginning when we first reach out and touch a company. So when a company sends in and delivers an application to us, if we're interested in that company and we want them to move forward, when we invite them into screening, it's with the understanding that they're going to get all kinds of feedback from us. As part of that process, they will come out of our screening meeting a much smarter company. But that said, we have never invested in a company that had no team members at all other than the founder, period, end of issue. We will likely not invest in a life sciences or a technology company that has been put together by faculty members from the university who are genius inventors but have absolutely no intention of giving up tenure and leaving the university to start a company. We will work with those people to help build a company and help build a team, and we will make those requirements of a successful due diligence process. We will even help recruit the people that they will need if they have no idea where to find those.
How about personality? I've heard that investors want someone who's coachable. So are your seasoned investors able to or are wary of certain entrepreneurs that come in with certain personality traits that you realize the venture's great, but it's just not going to go where it needs to go?
I think, unfortunately, it's safe to say that we are not able to always identify the deep-seated personality style of an entrepreneur from just a meeting in a screening meeting. But I can assure you of this. If they get invited into due diligence, the most significant component of that due diligence is the HR section. And we use professional PhD coaches and mentors to execute that HR section of our due diligence report. And those folks will come away and tell us whether or not this individual or this team of individuals is likely to be successful in getting this company over the goal line to get us a return.
So are you coming across entrepreneurs who have only one particular mindset, which is, how do I give the least amount away of my company for the most amount of money? Is that an approach or an attitude that is now less occurring because people are more educated about the investing process, or you're still seeing individuals come in and basically have someone's planted some type of rigid thought about the valuation and what they need to have?
I would say that 10, 11 years ago, 40 to 50% of the entrepreneurs that applied to us had that mindset. And it was their goal, come hell or high water, to give away as little of the company as possible for the most money they could. And that's all they cared about. They didn't care whether the money was smart or dumb. All they wanted was, give me the money and then get out of my way and let me do this. We started requiring our term sheet as part of due diligence about 5 years ago. And we have noticed a significant change. I would say that probably less than 10% of the companies that come to us today still have that old attitude, and 90% are looking for much more than just money. They absolutely want smart money. They want hands-on investors that are going to help them succeed and grow the business. And we have actually had entrepreneurs say to us that the feedback that they've gotten from the gold sheets was as valuable as the money they were anticipating from funding. And I very seriously say in our meetings, they lied. That's not true. Nothing is ever more important than the money. But it's good to know that we're talking to people who recognize and appreciate the value of the rest of what comes with that money can mean to them.
So where is valuation in this process? Again, the entrepreneur is new to this area. They're going to others and listening to other people's opinion. But where does the determination of the valuation play in getting a good deal in place?
Well, you can't negotiate a term sheet without having a mutually agreed upon valuation. So it's right at the very beginning of the process. I am on record as saying that in 36 years of being in private equity and negotiating deals, I can count on the fingers of one hand the times when I stopped and looked at the entrepreneur and said, I think your pre-money valuation is too low. So the goal of the entrepreneur obviously is to get the highest possible pre-money valuation that makes sense The goal, most people think the goal of the investor is to get it as low as possible. The truth is there's a lot more to valuation than just reaching a win-win solution in the middle. If the company is coming to us telling us that this is the only venture round they're ever going to need to raise to be successful, then the pre-money valuation number is lots less critical than for those companies that are going to need to come back and do a Series B or a Series C, et cetera. Why? Because if the pre-money valuation is too high in the first round, it will create a real problem for the follow-on round. So again, as part of that educational portion of the process, entrepreneurs need to appreciate where that stands. I can share with you anecdotally and historically that in the 11 years of doing Keiretsu, if I had to pick a number, I would tell you that in the typical A and B rounds that we have led in the last 11 years, the cap table indicates that at the end of that successful raise, the investors typically own somewhere between 25 and 30% of the company. So the valuations can be incredibly different, incredibly difficult. In Savara Pharmaceuticals, a company we started investing in 10 years ago, which is now publicly traded, by the way, we invested in a first round at a $17 million pre-money. In the last round we invested in, we were investing in an $80 million pre-money valuation. We expect it to go up.
So, Howard, after the entrepreneur has been funded, what should the entrepreneur anticipate in the relationship that it is starting with the angel group as they're beginning to access those funds that are so important to them?
I think it's safe to say that 80% of the companies that we fund discover fairly quickly after we hand them the checks. And remember that they get a lot of checks because each of our members writes their own investment check. But after the funding is done, I think there's an epiphany on the entrepreneur side, because from the beginning of the process, we've been telling them that we're going to be hands-on involved to help them succeed from the time we got the application until we get to the liquidity event. They probably hear that from everyone they pitch to. The reality is that most investment groups, and in the angel space specifically, most of the very early startup angel groups are making so many small investments that they really can't afford to stay on top of them. We're doing much bigger deals at a much later stage typically. And as a result, when we place board members, when we place advisors with the company, when they get phone calls unsolicited from a Keiretsu member who says something like, I met a guy today who just sold a business in your space. I was telling him about you and he's interested. He may want to talk to you about how he may be able to help or anything that he can do. And by the way, it looks like he's going to join Keiretsu. So the epiphany is that we really mean it when we say we're one to two investors and we stay engaged and involved. And I think it's a shock to the system for most of the management teams that we work with initially. And then slowly but surely, they tend to start to depend on us to bring that support and to help them succeed.
With the funding, or how the funding is set up, is it tied to, since you're doing specifically a Series A, is it tied to a milestone that the angel group has in anticipation of that money going into the company?
Well, there's two sides to that, Jeanne. On one side, when a company comes to us and says, we need to raise $3 million, as part of that conversation and negotiation, I asked the company, tell me what the absolute minimum amount is that you need to raise. Let's just assume we do a $3 million raise, and for some reason, we only get to X. Tell me what X has to be to guarantee that the company will survive, recognizing that it may take much longer to get it over the goal line with limited funds, but so on and so forth. And from that conversation on the money inside, we negotiate the first close to protect the investors, but to also understand what that minimum amount is the company needs. And by the way, in many cases, they say we need the whole $3 million or we can't get there. The other side of that coin is that once we have successfully raised the money, the company has already told us as a result of the due diligence what they're using the money for and where they're going to go. And if it's one of the situations where they're going to be coming back for a Series B, then we obviously monitor the milestones that they indicated in our due diligence to make sure that they're staying on track. And obviously we have board members in place to help us stay current and knowledgeable what's going on. In the case of those companies that have told us, if you help us raise this $3 million, we'll never need any more, we're much more hands-on and helpful because we love to be in a situation where we're the last money in and we've negotiated a win-win term sheet, knowing that if the company can deliver what they've told us, again, based on the research and the financials and everything else, we can anticipate what the likely return on investment will be.
So I've heard an angel investor, a bit of VC actually, who said that in the first year, they often anticipate that the business plan that was presented to them has changed. Now, is that something that would be more associated with a seed stage, or does that happen in Series A, that they've learned more about their market and now they've got to do something different?
Well, I think it's fair to say there's a very famous saying from a very famous boxer that said, no matter what your strategy is, that first shot up the side of your head changes everything. But that said, I think it's fair to say that when the companies are coming to Keiretsu, and again, we have the advantage of getting them at what I would refer to as early stage, but certainly not startup. They've made the majority of their startup pivots, if you will, before we get them. And when we get them, that doesn't mean that there won't be an additional pivot, but it's never going to be, almost never, going to be 180 degrees or 360 degrees. It may be 25 degrees. We had a company present to us today, for example. Today was our forum meeting day. So we had a company that presented to us today with a very unique medical device that's designed to be loaded with a medication. And their first target market is the opioid crisis. So they can load Narcan into a device that the patient then swallows. And this device lodges in their large intestine for 3 to 5 days and can automatically be triggered to release the Narcan on an emergency exit. In addition, they could load an opioid into that same device, have the patient swallow it after, let's say, some kind of major surgery, and then the doctor can control the release of the opioid for pain management without any chance of the patient being able to overdose. Now, they tell us that their primary market is opioids first and then everything else. And a couple of our members who are life science experts pointed out to them that if with the pressure that's being brought on the medical industry to stop writing prescriptions for pain relievers, they think that the first market should be the pain resolution and so on and so forth, and then the opioid crisis secondly. And the company was receptive to hear that. Now, the next step for us is to see how well they were received by our members and see if the gold sheets indicate that we're going to take them into due diligence. And then as part of that due diligence process, I can guarantee you that at least one of those two medical experts that were on the call today will be involved in that due diligence, and they'll explore that. So that's what I would refer to as a small pivot, as opposed to what happened much earlier than us.
So we're getting close to wrapping up, and I wanted to backtrack on two very common questions that are posed to investors, but specific the fact that, we've spoken about you're focusing on Series A and certain funded amounts. Is there any value of an entrepreneur approaching Keiretsu who's not ready for you, but they want to bring their attention to themselves as soon as possible?
Yeah, well, again, there's multiple ways to look at that. The information that's available on our website, I think, clearly helps indicate to the entrepreneur at what level we're most likely to engage. That said, and I'll use an example actually from last month's forum meetings. We had a company out of Philadelphia that came to us 2+ years ago, and they presented, and it happens to be a company that's in the orthopedic surgery space. They've invented a piece of medical device that looks to be better than anything else that exists in that space today. But 2 years ago, when they came to us, we were very receptive to the idea. Again, our medical SMEs were all over this thing. They said this could be a game changer and so on and so forth. But we both very quickly recognized that the company was absolutely not ready for us. And we parted friends and moved on. And then last fall, one of our members, who happens to be a medical device investor and owns a business that does nothing but that, brought the company back to us. And we met with them in the fall. They came and presented. We did due diligence. And I'm pleased to tell you that this week we opened the due diligence funding portion of the process. So if an entrepreneur comes and it's too early, we certainly aren't going to put them in a place where they're going to fail with our members. But if they come and they're too early, we'll tell them they're too early. Come back when you can do this, this, and this. The truth is, if they're astute enough, they can get the answer right from our website when they understand that, as I think we mentioned in an earlier part of our call, the perfect inflection point for a company coming to Keiretsu, with the exception of life sciences, is one that is ready to transition or has just transitioned from R&D to sales and marketing. And if they're a medical device, they're coming to us because they now need the money perhaps to execute a clinical trial to get FDA approval, but they already have the prototype. They already have some traction in the market, meaning they haven't sold any because it's not FDA approved, but they've gone out and done the customer discovery, and subject matter experts have said, if you get this out, I'll buy it, I'll use it. So it's a different approach.
Now, one last question in that area. So a lot of emphasis is put on the pitch deck. So when they contact again for a presentation, where does the pitch deck come in and timing of you and a follow-on presentation?
Well, I would say that we're a little different than the typical angel investment group when it comes to the pitch deck. When a company applies to us, we haven't seen a pitch deck. We've only seen what they put on the application. We may do some follow-up with them, but if we invite them into screening, we intentionally do absolutely no pre-vetting of their deck. They present the deck to us in what I would refer to as raw form at the screening meeting. And if they can get through the screening meeting with the deck as is, that's an enormous success, because before they come back to the forum meeting, they must spend time with our professional coaching team. And our professional coaching team is going to fine-tune that deck and work with them to make that presentation perhaps 2 or 3 or 10 times better, 10's an exaggeration, but 2 or 3 times more effective than it was when they pitched to us at the screening meeting. So the pitch deck is critical for attracting and interesting our members to invite the company into due diligence, but it's not the end all be all of the process.
So we approached our conversation with what makes a good deal. And we've discussed it from the point of view of what the investors are looking for and how the entrepreneur needs to position themselves and be prepared for what the investors need. So sort of as we wrap up, are there 2 or 3 core points, sort of like as a checklist of what the two parties have achieved for having gone through the process?
Sure. Well, first and foremost, the deal has to be win-win. It's not about begrudgingly giving a company and its management team as little money as possible for as much equity as we can get out of them. I would be remiss if I didn't point out that there are some people out there that do that. The reality is that the vast majority of us do not. And in the case of Keiretsu, we struggle sometimes to get to a win-win with the understanding that if in any way the deal demotivates the management team to get the company over the goal line, then none of us will win. So we help, I think, we go out of our way to make sure that the entrepreneur understands that it needs to be win-win, that in some cases, especially if they're going to have a follow-on round, they're going to have to be more flexible with where they set pre-money valuation as part of the process, and the other 20 pieces to that puzzle that have to come together that will guarantee interest and involvement from investors so that the company can raise the money they need to succeed. The follow-on support and board support and everything else that goes with that, is part and parcel of the solution. So again, it's what the industry continues to call smart money. And I would like to think that the process at Keiretsu is the ultimate on the Angel side smart money investor solution.
Well, Howard, it was great chatting with you for our podcast. I look forward to picking up other conversations with you in the future.